the arguments around whether the higher interest rates will keep on impacting markets over the medium term are very loud, as are the arguments that, hey, the opening up world will bring about economic growth at some point of time, hopefully, and valuations have corrected a little bit. How are you approaching this?
So, I mean, there are many arguments for or against any market situation permanently. It's nothing to do with now. There is enough at any point of market history. There will be enough arguments to support a bear market thesis and enough arguments to support a bull market thesis. So the interesting thing is all those things are logical. All those things can work, but it depends on the market whether it chooses to focus on one or the other. The decision on what the market what the market's own feel for direction is based on the market's own decision to pick a bull argument or a bear argument. And the same argument in a young bull market, I mean, a bear argument in a young bull market will not derail it, but the same argument in a mature bull market will derail it. So a war in a young bull market will be shrugged off, saying it's okay, it's temporary, 4, 5 months, 6 months, a year, it's okay, market will look past it. But when it comes at the end of a 12 or 13-year-long bull market, it has a disproportionate impact. Inflation can have the same effect, right? You can always argue that this is temporary, this is transitory, or 6 months down the road, it will be the base effect will kick in, and therefore these numbers optically will look, inflation will look lower. But that argument will work when the bull market is young, when it is an aging bull market, as it has been in the world, not so much in India. India has actually not had much of a bull market, to be honest with you, from 2008. But ignore that for a minute. So therefore, the way I'm looking at the market is very simply this. The markets were and when I say markets, I'm saying more the US market or the global markets rather than India, again, to clarify, were looking for a reason to fall because they had gone on for too long. And in particular, 2019, 20, and 21 were solidly up years, were massively up years. Statistically, you will always have a down year in the fourth year. Okay. It has never probably happened in the history of the world that you've had 4 consecutive up years in markets. So markets were looking for a reason. Now, there are enough reasons out there, a war or inflation or crude or something will be there. Okay. So I'm not surprised at what the market has done. It was, in fact, by the middle of last year, I was very clear that 2022 will shape up to be a difficult year. I didn't know the reasons why, but I knew statistically it was due for a down year. And we are getting exactly that.
Yeah, it's something that you pointed out in the last interaction as well. So yeah, I should have kept note of that. In which case, Shankar, is 2022, as things stand as of now, a year of capital preservation more so? Or do you reckon that you are still going out there and trying to make the alpha or the delta, as the case may be?
I'm absolutely going out there and doing all the Greeks, as whatever other Greeks might be there from alpha and delta and whatever else there is, to create a portfolio which will last solidly for the next 3 or 5 years, because the bear market is a tremendous friend. It's not an enemy. We have regarded it as an enemy for all the wrong reasons. So here is my thesis on a bear market. Okay, I have got every single bear market right from in the last 22 years. I've never got that wrong. I might get a bull market wrong once in a while, but that's okay. There is enough ways to make money on the long side. But if you get a bear market right, here is what happens. Okay, you get 2 things. Number one, you don't lose as much money. So when I said that I'm rocking, okay, it doesn't mean that I'm not losing money. I'm losing money, but I'm not losing as much as the average investor, Joe investor on the street, who goes out there, listens to people coming on television saying all is well permanently. Okay. And that's why they are destined to never get seriously rich in the markets. Because when you spot a bear market from a distance away, you positioned yourself through a variety of means to not lose as much money. You will get hit. Okay. But you will not have a 80% down or 50% down. Okay, you might be down 20, which is easily recovered. And the second thing is that the way you will recover that 20 or 30 that you might lose in a bear market will be by a rotational switch away from the losers in your portfolio, the significant losers in your portfolio, to what is winning in the markets. So even right now, okay, to give you live example, there are enough stocks, let's say the larger basket or the small or the mid cap universe in India, which are trading near about highs. The index is down, I think, 20-25% in the last couple of months' time. There are enough stocks which are trading at highs. That is the group you need to belong to. If you don't belong there and you're going to nurse your losses, you're never coming out of this hole in a bear market. Okay. I also have losses. I've got stocks which are down 40-50%. This calls for ruthlessness in eliminating those and buying strength, which is why a bear market is a great place to build core strength in your portfolio. Don't fear it.